Welcome to the Explainer. Hey, future CPAs, today we're cracking the code on a topic that trips up tons of students in the LECPA, the global showdown between US GAAP and IFRS on cash reporting. Seriously, getting this stuff down is going to make a huge difference, so let's get into it.
So, let's just dive right in with a classic exam question, something you'll definitely see. Imagine a company's bank account is in the red. Is that a liability, or can you just call it negative cash? Well, the tricky thing is, the answer actually depends entirely on which accounting rulebook you're using.
So, why are there two different answers to the same question? Well, to understand that, you first need to meet the two main players on the world stage of accounting standards. This isn't just theory, it's how the biggest companies on the planet operate.
Okay, here's the best way to think about it. Imagine US GAAP is like the NBA. It has a super detailed rulebook for pretty much every situation you can think of. IFRS, on the other hand, is kind of like FIBA basketball. You know, the international rules? It's basically the same game, but a few key rule differences can completely change the strategy and, honestly, the outcome.
All right, let's get to our first head-to-head comparison, how we treat a negative bank balance, or a bank overdraft. I'm telling you, this is a total favorite on the board exams, so pay close attention.
So under US GAAP, the rule is strict and super simple. If you have a negative balance, you owe the bank money, period. That means it's always a current liability, no exceptions. Easy to remember, right?
But then you have IFRS, which is a bit more flexible. IFRS recognizes that, for some companies, dipping into an overdraft is just a routine part of how they manage their money. If that's the case, they can just treat it as negative cash instead of a whole separate liability.
Now, what's really interesting is how this table lays it all out side by side. You see the key difference for IFRS? That little condition at the bottom. The overdraft has to be part of an active, integral cash management system. Remember that phrase? It's gold. Next up is the statement of cash flows. And this is where GAAP and IFRS have some major disagreements on how to classify really common business transactions. This is a big deal because where you put these items can completely change the story your financials are telling. So, the US GAAP approach forces most of these items into the operating activities section. Why? Well, the logic is that they all flow through the income statement when you're calculating net income, so it keeps everything neat and tidy.
IFRS, on the other hand, gives companies choices. It argues that, for example, interest paid could be a financing activity for one company, but, say, for a bank, it's totally an operating activity. IFRS lets you make the choice that best reflects the reality of your business.
And this table just brilliantly illustrates that core conflict. Just look at all the OR options that IFRS gives you. These are the crucial points of difference you need to memorize. For real, this is a hotspot for exam questions.
Okay, here it is. This is the slide you've been waiting for, so get ready to screenshot this because this is your ultimate study guide. No fluff, just the essentials you absolutely need to know.
So, the crucial point to lock in your brain is this. For the LECPA, you've got to know that GAAP is rigid, while IFRS offers specific, consistent choices. Just burn this slide into your memory, and you'll be set.
And this leaves us with a final thought to chew on. If two different rulebooks can tell such different stories about a company's cash, what does that even mean for the truth of a financial statement? Understanding these rules isn't just about passing an exam. It's about learning to read the different stories that financial data can tell.